Hello friends, welcome. Friends, we have recently seen a significant depreciation of Indian rupee versus US dollar. So if you look at this table that is right in front of you, which is the HBS Table 218, which gives the daily exchange rate of Indian rupee versus all major currencies, US dollar, euro, pound sterling and Japanese yen, you will find that the rupee depreciation has been very significant, and it was 83.08 in the month of January 2024, and then it has suddenly spiked up to 85.08. And the recent article which I saw today, which basically points to a value of 85.61. So this looks quite strange, right? That suddenly there has been a significant depreciation of rupee, and rupee is not, we are not able to stabilize rupee. And also, one thing is pretty strange is that if you see, let me just zoom out, you'll see that as regard other currencies are concerned, for example, euro, there was a depreciation. It basically went very high in the month of September and then it has fallen. Similarly, all other currencies are basically showing a hump kind of pattern. Even Japanese yen is also showing a hump pattern. Only the US dollar is versus rupee is continuously depreciating, and it is kind of, I don't know where the end is. So I thought of investigating this. A lot of articles have been written about this topic, and based on the data that I posted on my website, I do a lot of analysis of data, especially in the RBI website. So I thought of investigating this issue. So I went into the US SLT table. So the SLT table 2, if you look at this table, and let me just zoom in a little bit so that you can understand what this. So in US there are different tables, SLT1, SLT2, SLT3 in the TIC database. The SLT2 gives the foreign long-term stock, long-term security held by US residents in other countries. So I have created a heat map, right, which is kind of shows billions of dollars. So in this heat map, what I am plotting is the total foreign currency for total foreign security holding of US by US residents in foreign countries. Foreign countries means United Kingdom, Japan, Netherlands, India, and all these countries which are listed here. And the heat map, which is plotted on a time scale here, is shown here, right? So you will notice that in the month of October, there has been a huge, sale of US securities for US, dilution of US residents' foreign position in major countries, which is not seen in the other months. There have been some dilution here and there, but there is a significant dilution, which is very strange, especially in the month of October. The November and the December data is not out yet. So this is a fact, and this dilution has resulted in India's US citizens' security, long-term security held in India to have dropped from. So if you look at this chart, this is the India bar chart. It increased, and now it has dropped from 441.7 to $413.7 billion. And maybe I'm speculating that it has gone down further because of the depreciation of rupee that we are seeing. So because of this trend, because of this dilution of position and the money being extracted out from India and rest of the world, looks like because of that there is a huge devaluation of currency which is taking place, especially rupee, and maybe some other parts of the world currency also getting depreciated. So now let's look at the fundamental problem or the fundamental reason, and which is the foundation on which the currency depreciation takes place. Because these volatility of funds erosion from one market to another market is a temporary phenomena. It can be driven by you can say that macroeconomic conditions, shocks, etc. So those are very temporary, and you can't really predict these things. These can happen anytime, and there could be some shocks which will happen in the market, for which the currency can depreciate here and there. But let's understand from a long-term perspective why currency depreciates. because that is the whole foundation of this video. And while I was working on this particular topic, I did some research and used some database to kind of see why currency depreciates. So what I did was I went into the Bank of International Settlements website and downloaded certain charts, certain data from there. So let me show you. So this is the dashboard which I have created. And this dashboard consists of, the title of this dashboard says currency fluctuation with respect to US dollar versus CPI index of a chosen country. So what does it mean? So there are two parts of this dashboard. If you see, there is this is the window, top window, and then there is a bottom window. Now the top window has got two curves that you see. I've chosen India as the country. So this one curve is here. Another curve basically goes in this direction. Now, what are these two curves? These are the ratio of the reference index value, that is the index value of CPI, well, consumer price index value for US. This is US and this is for India. This is for India. So what basically it means that, see, if you go to the BIS website and if you download the database, they will give you the index, CPI index value of a respective countries. So you can get it for India, for US and other countries. So what I have done is I have taken the CPI index, which is held at the reference rate of 2010 as 100. So what I've done is that I've taken this reference value in the start of the window, right, and divided it by the same reference value. And as the reference value kept on changing, the ratio keeps on increasing, right? You see, it started with 1 for India and then the ratio has started increasing and it has gone to at the level of 7, right, in the October 2024. Similarly, if you see, it is July 1991 for US. It started with 1 and it is now at 2.3. Why I have taken ratio? The reason I have taken ratio is that it is a very good metric to compare two different CPI index for two different countries. Because individually you can't compare them, but if you take the ratio, then you can basically see that how these things have, how the inflation has moved, because this is a measure of inflation. So this curve that you are seeing right in front of you is a measure of Indian inflation, and this is the measure of US inflation. Now you can see the gap between these two inflation. This is the gap, right? And because of this gap, you will find that the currency, the Indian currency, which was at 25.6 Indian rupee in the start of the window period, which is July 1991, is now at 84 rupees when this data was available, which is October 2024. After that, there has been a huge depreciation, significant depreciation. Now it is 85.6, right? So you can see that India, because the Indian inflation is significantly higher compared to US inflation, because of that, the currency, though it kind of fluctuates over a period of time, it goes up and down, but over a period of time, the currency will depreciate aligned with the inflation rate. That is what the tendency which I find in all other countries. So let me just pick another country. For example, let's say if I pick a country which is, I can say that almost like at par with, let me just pick Indonesia, let's say Indonesia. So if I pick Indonesia, you'll find that in Indonesia also, the inflation is like this, right? For the Indonesian currency and compared to US, there is a huge gap. Similarly, you will find that the Indonesian currency is also depreciated, right? And there was a huge spike here of depreciation. There could be other, macroeconomic shocks at that particular point of time. But on an average, you will find that it started here, right? And then it basically went and depreciated to this value. Let me just take another currency where, let me just take Japan, for example. Japan. And if I take Japan, you will find that the Japanese currency has remained kind of stable, right? Though it has depreciated, remained stable. And you will find that the inflation between the US inflation is higher than that of Japan. You see? Japanese line is here, the US inflation is higher. right? So that is why the Japanese currency has remained kind of stable, right, versus the US currency. So let's pick up another country, for example, let's say Switzerland, right? Here also you will find that the US inflation is higher in Switzerland. Switzerland, the inflation is lower, and therefore the currency actually has appreciated compared to the US dollar. If I take Thailand, you'll find that the Thailand, the inflation basically was higher, and then it kind of collapsed to both of them actually has converged to this particular point, which is very strange. So here also you will find that the currency actually has remained kind of stable, right? It has not, though there have been a period of huge depreciation, right, of currency because of maybe because of inflation which has gone higher, and then finally it has converged, and now the currency is kind of stable. Now let's look at some other country like Norway. Let's say Norway, you will see that both the inflations are at par with each other. So currency has not depreciated significantly. It has remained kind of stable, right? It has appreciated in between, and now it actually has gone. So the US inflation is a little higher compared to Norwegian inflation. So let's take another country, for example, South Africa. Here also the same situation. See, South Africa inflation is much higher compared to US inflation, and therefore the currency has depreciated. So this is what I find, very strange. And one thing I notice is that if you take the ratio of this value, the ratio of 7.3, which is the starting point, the value which was at the starting point to the value of CPI index at the end point, if you take the ratio of them, which comes out to be 7.3, for the US it is 2.3. But if you divide this 7.3 divided by 2.3, so this value is what? It comes out to be 3.16. And then if you divide the value of this with this, it roughly kind of matches. It is a little odd here for South African rand, but for India, let's say, you'll find that it is somehow, closely aligns. In most of the countries I see, it kind of aligns. Like here it is 3.01, here you say 3.28. If I take another country, for example, New Zealand, I'm just speaking of any country, it is 2.3. Here it is 0.93. It is not matching very good. But some countries, it amazingly kind of it matches. Let's say Sweden, it is 2.3. Here also 1.72, right? So what I'm basically trying to say, friends, is that ultimately the whole point about depreciation of currency is linked with inflation. If your country's inflation is higher compared to the US market, your currency is finally, ultimately is going to depreciate. You cannot stop the depreciation of currency. Now, what RBI does, right, when it intervenes by buying and selling dollars, right? If you look at this is the table which I extracted from the RBI's website, which is RBIB table number 4. This is the table which kind of captures the net purchase and sale of foreign currency by RBI on a monthly basis. This is purchase. This is the net purchase. That is purchase minus sale. So purchase is positive here, and then the sale is here, which is negative. So if you subtract this 2, this comes out to be this value. So in October there is a sale of minus 9.3 on a spot market by RBI, and the forward sale. This is the forward sale, which is kind of RBI making a bet in the future. Right? Not this does not expense foreign exchange immediately, but it is the forward sale in the future, which kind of gives an indication that how much RBI is speculating for the dollar to appreciate, and therefore it is intervening in the market, in the forward market. So that is an indication that RBI was anticipating that rupee is going to get devalued, and therefore this forward position RBI has taken in the month of October, which is huge. You see, minus $49.2 billion, and it is very, very high compared to any of the earlier previous month, right? Which is an indication that rupee will appreciate, and this is one of the major reason why the behavior of in the market as regards rupee dollar gets influenced, because this number is available for people to see, this forward position which RBI takes versus the spot position. The spot position does not really impact significantly the dollar versus rupee rate. compared to the forward sale, which is a speculation in the future. So that's how the reserve position also changes depending upon how RBI intervenes, and which I did in one video, which I told that this is also including the valuation effect. It does not reflect the actual sale and purchase of dollar, but also the value of foreign exchange reserve includes valuation also, which kind of changes over a period of time, right? Depending upon what the valuation is. So that's all, friends. In this video, I thought of doing a little bit of deep dive to show that how currency fluctuation takes place. It is mostly linked with inflation, which is the core part of the issue, which kind of drives the macroeconomic numbers like policy rates and like the trade balance between two nations, right? Because if the currency is depreciates, then imports become costly, exports become cheaper, which kind of results in flow of goods from one part of the world to the another part, resulting in trade balance imbalances, which is kind of captured in the BOP statement. And finally, this BOP statement is very, very crucial to understand the dynamics of trade which is happening between India and rest of the world. So thanks, friend, for your time. I will come back with next time with a new video on a new topic. Thank you very much.